All right, I'm about to get stuck into my trading, and in this video I'm going to share with you how to trade one of the most popular patterns in trading, which is a head and shoulders formation. And the head and shoulders pattern can be taken in different ways, and the reason this one's a great example is because one, it's playing out right now, but two, it hasn't hit targets yet, but three, there's some unemployment news out on the dollar later which may see that target be triggered. But I'm going to go through the conventional ways to take it and the way that I trade it personally as well. So you're going to get a lot from this. Make sure you take notes. Let's get stuck in. First of all, the pattern is a reversal pattern. Okay, so whenever we're looking at a market, it's either trending up or trending down, or we want to spot the end of the trend so that we can stop taking those trend continuation setups or trend following setups and potentially start looking for the reversal and look for when we can start shorting the market if we're long, or buying the market if we're already short. So what a reversal setup is a price action pattern. It's price telling us a load of clues, giving us a load of clues that says the momentum in this trend is no longer strong, and we're likely to roll over or potentially rotate or reverse. So what the head and shoulders is a price action pattern that gives us those clues. And really, you know, when you think about it, it's a loss of momentum, loss of strengthening, it's a deceleration in a trend, you know. And what that means is the first thing I like to look like, this is a bullish market, right? The first thing I like to look at is previous structure. So if I can dip out to the higher time frame and start looking for a previous level of structure. Now we've got this level here, okay? So this isn't strong enough for me, right? I would only look for reversal setups like this up here at the highest high, the highest probability move. And you know what I would do normally is I would bring on my rectangle tool, and if you're in tier 1, you've got the VS1 tool which prints this on automatically for you. But I would bring on the horizontal rectangle, I would draw that on, and I would say, right, I'm not looking for any reversal setups until we get up to here, because I'm not predominantly a reversal or counter trader. I only take certain counter trades or reversal setups at major levels of structure. So this one wouldn't be for me, right? But what clues do we have? Okay, well, we've got this little previous resistance here, which was support. Okay, so we had this support level here, resistance here, we're in that zone. We've got this doji on the daily, which means indecision. Okay, so that we pushed up, pushed down, closed where we left off following this big bullish run. That can indicate that there's a potential hold there, right? And I know this is in hindsight, but look, play along with the story. So we've hit this 61 flat level, psychological even handle number. We've got a doji candle, which is indecision. So when we start to drop down to the trading time frames, we can start to look for more clues. And what we've seen is on that 60-minute time frame where we had that doji, look, we had this rejection, rejection, rejection. We had this high test wick as well. Okay, so all these clues. Then we roll over. So we've put in this new high here. We've pulled back. We've put in this new high. We had all the rejection here and the doji on the daily. And then look, we pushed up and rolled all the way back down to where we left off. Okay. And then what would happen next is we pushed up again, but we put in a lower high. And then we started to roll back down. And at that point, the price action pattern is qualifying for what we call a head and shoulders. And the reason it's called a head and shoulders is because it looks like two shoulders with a head in the middle. That's basically it. And there's three types of head and shoulders. There is a head and shoulders that is horizontal. So this is the most common and conventional head and shoulders pattern that looks like this, right? That's a conventional head and shoulders. That's a horizontal head and shoulders, and really it's just a reversal or a rotation in trend. Then you've got the upward slanting head and shoulders, okay, which looks like this, right, where you've got the upward slant neckline. And then finally, you've got the downward sloping head and shoulders, which looks like this, where you've got a downward sloping neckline. Okay, now what one out of this is the most common? You get the most opportunities with this one. Okay, this one is the highest probability setup, so you get the higher strike rate with this one, and this one is the lower probability, but highest risk reward profile. Okay, so when this one plays out, you get the best risk reward profile, but it doesn't play out as often. Okay, so highest strike rate, sorry, highest opportunity. These ones happen most common. These ones are the best reward. These ones are the best strike rate. This one's the best reward to risk. So there's benefits and drawbacks to all three. Okay, what we're going to look at now is what happened here. So how do you identify the head and shoulders, and how do you identify where to get in, where to get out? So once we've got the head and shoulders formation, what I do is I go to the lowest close, so you see this? Lowest close, and I draw that across, and you can draw it indefinitely, or you can just draw it out. There's an indefinite line here. I think it is the ray line. Don't know. Ray. I think it's the ray, right? So you bring this on here, bring this on here, and there you go, right? So there's your neckline. So this is an upward slanting neckline, which I say is the lower probability, but the highest reward to risk profile. Okay. Whoops. Let's just get rid of that. Just turn that off. And what's happened here is, let me just bring my trend line on again. We've got the first shoulder. Let's bring this back. We got the first neck touch. Then we've got the head. Then we've got the second neck touch being respected. Shoulder line being respected. And then we've got that retest of the neckline. And then we break through. We've got this big bearish rollover here. Okay. Now, the conventional ways of trading this. The conventional way would be you wait for the break of the neckline. So you would set an order, you would set a sell stop order, or you would get in at market. And this would be a short position. And what you'd be doing is setting the order. As the market's pushing down here, you would be setting an order just below that neckline, whatever rule that is for you. 3 pips, ATR, 10 pips, whatever it is. And conventionally, the stop goes above the head, and the target is a 1-to-1 normally. Okay, now that's a very conventional, textbook way of trading a head and shoulders setup. All right. Now, some people have adapted that, and they like to put the stop loss above the shoulder, and then trade a 1-to-1. So there's that way of doing it as well, and that's another great way of doing it. Or you could go for more than a 1-to-1. You could keep, you could keep this target at the lows, and you get maybe more than a 1-to-1. My way of trading it is slightly different, because I want minimal risk, and I want a great reward to risk profile. And the way that I do it is I wait for a test. So I wait for the break to play out, and I don't get involved. And then what I'm doing, so I'm being ultra conservative. I'm waiting for confirmation that we've got that rotation. So now that we're not in a bullish trend anymore, we've got the higher high, then we've got the lower high, and then we violate the previous outside return. We put in this new low. Okay, so now I've got added confirmation that we're likely to continue down. And the way that I do it is I let this play out, and then I let price push up, and I'm waiting for the candle that tests this neckline defined by this ray line, which is defined by the neckline. Make sense, everyone with me so far? So I wait patiently, and I watch the market push up, and I can't get involved yet, and and then this candle here, this tests the neckline. So what do I do now? What I do now is I have to wait for this to close. So it's still patience, right? You have to wait for this candle to close. And the reason you have to wait for this to close is because you're then going to set an at-market order, and you're going to place an ATR-based stop above the high of the candle that tested that neckline. See all of these very objective rules, very easy to remember once you know them. So once this candle closes, the order gets placed at market, because it's an at market order. This one, you have to be there, because if you have to wait for a candlestick to close, you have to be at market. Okay, and then what you're doing is placing your stop loss and ATR above the high of that candle, okay, which might be 20 pips, 30 pips, 40 pips, depending on what pair you're looking at. And then the target goes at the lowest close, okay, so which is this candle here. See this? This is the lowest close. Everyone should be able to see that that is the lowest close. And if you don't know what a close is, you need to refresh your candlestick anatomy. But this is the close right here. If you hover over this candle, you can see up there on the left, top left, it says close is 0.6054. That's the close. So the target goes there, plus front running a couple of pips. Now you can see that's a what is that? A 3.2 to 1. As I said, the upward slanting necklines are always better reward to risk profile because you're getting in higher. So that's it, right? If you was in this now, you would have entered at market. It would be about 8 o'clock, 9 o'clock last night, and you'd just be letting this run, letting this roll. You can see we hovered around. It's looking good. It's looking good. We're about 40% to targets right now, but we did push down to about 70%, 65% to targets. And then you just leave it in. So that is the way that I trade head and shoulders setups. Again, I do it on the pound yen and the pound dollar. I only trade those two pairs with this type of setup. But this is a great example of how you might trade head and shoulders setups. And the conventional way, as I say, is a stop loss above the head with a 1-to-1. And then this way is much better in my opinion, because you keep the stop loss tight. You keep a good reward to risk profile. Even if you get those horizontal setups or a downward sloping setup, it's still usually better. The problem with the downward sloping is you're probably going to have a 50-50, a 1-to-1 reward to risk at best. Okay. Sometimes it might even be inverse. So the downward sloping ones, you might get an inverse, but because the strike rate is so high, because think about it, right? If you've got a trend, right, and then we start to put in this head and shoulders, right? If we get a violation on that first neck of the previous outside return, this is already a strong signal that we are likely to roll over, right? So then if we do this, think about this, right? We're already halfway rolling over. There's much more momentum in the downward direction. Does that make sense? So of course, it's going to be a higher strike rate. This is a much more stronger signal of a rotation than this, right? Think about the story of what price is telling you. So on this one, you're going to have a much higher strike rate, but you might not have a great reward to risk profile. Because if your stop's up here and your target's only at the low, it might be a 0.9, 0.8 to 1, might even be a 0.7 to 1. But because the strike rate is so high, you might not mind it because it's right most of the time. You might be right 8 times out of 10, which means you can afford a smaller target as opposed to your risk. All right, so if you want the rules for this kind of setup and many, many more setup strategies that have been tested, proven and verified to have an edge in the market, and you want to learn how to develop them into your own trading style and your own personality and your own lifestyle in a way that you can trade them consistently, then go over to tier1trading.com. There's a trial option there where you can come in for 14 days. You won't get auto build or anything like that, right? And you can have a look around. And if you like what you see, you know you're in the right place. Until the next one, take care, and I'll see you then.